Hello, everyone. Thank you for joining us for our final webinar of our series for disaster assistance. Throughout the last year, the Farmer Veteran Coalition has been working with Flower Hill Institute and other collaborators to provide disaster relief outreach, education, and technical assistance to help farmers and ranchers access FSA disaster relief resources. Some work that we've done over this past year includes webinars, workshops, again, outreach, providing just education and more information about what's available to beginning farmers and ranchers, especially for veteran farmers and ranchers, about the programs that are available for them. I know we've had a lot of disasters going on lately. Here in Texas, we had flooding in Hill Country. I know we're in hurricane season right now, and there's some fears of some hurricanes going on in the East Coast. So we're hoping our information will be helpful for our members. And if you have any questions, please reach out to us at support@farmveco.org. I'll let Chloe speak for a bit, and then we can get Gary Madison, who's joining us today, to go over business basics for beginning farmers, which is useful for our members, especially in cases of disaster assistance, to be prepared. So, Chloe, you got a few words?
Hi, everyone. I'm Chloe Painter. I am the veteran service provider for FVC. So I do a lot of the technical assistance help. Like he said, we've been working with Flower Hill to get FSA information out on how to deal with disaster relief and recovery. We've been doing outreach. We've done these webinars for almost a year now, each month, and just all kinds of other things to kind of get that information out, because a lot of the time people just simply don't know what to do when there's a hurricane, wildfire, drought, etc. So that's kind of where we've come in to try to push that information out. So hopefully y'all have gotten some use out of that, and we will, just continue to do that type of work and release information out as it comes to us. So thank you so much for being here today.
Thank you for that, Chloe. And Gary, thank you for joining us today, and I'll let you get started with your presentation.
All right. Thanks, Diego and Chloe. The goal of this webinar is to describe some key financial tools, but more importantly, to describe why they should be important to you and why you would take the time to learn about them. And what I'm going to be talking about are really things that are well in advance of a disaster. And you'll see that as I go along. But if you wait for disaster planning until a disaster happens, you're going to be too late. And part of planning for a disaster is just to have a plan for what you are going to do in your business in the first place that you can then adjust because of the disaster. So that's the perspective I'm coming from. So learning how to use key financial tools is a lot like learning another language. Let's call it the language of business. And my intent is to show you how important it is to learn that language of business. If you were going to go live in Italy for a few years, you'd probably study Italian in preparation for being able to get along with the locals so that you could ask basic questions about how do you find food and shelter and clothing. And you'd also want to be able to have meaningful conversations about how you see the world, what your aspirations are, how you're doing is finding satisfaction in your life. So if learning the local language is necessary for a long trip abroad, likewise, learning the language of business is necessary for your extended stay in the world of farm business. The more fluent you are in the language of business, the more likely you are to succeed. We all have some idea what success is on our farm or ranch operation is going to look like. I'm going to make the case that by setting expectations for your business, which includes setting expectations for yourself, you'll have a much higher chance of achieving success in life. Farm businesses are typically intertwined with family life. And in fact, that is probably one of the reasons you're attracted to farming, because there is such a special joy in having a seamless boundary between family and work that can produce meaningful and productive quality of life. It's really pretty simple. If you want to reach your goal of running a farm business, you have to plan to make money. If you don't make money, you can't keep doing what you want to do. If you want to stay at a small scale, that's fine. You still have to plan for making some amount of money. Making money from your farm business allows you to have choices. If you fail to make money, there's a limit to how long you can keep losing money. Even if someone gives you a pile of money to do whatever you want, you still have to have some sort of plan to spend it and a plan to earn money by selling something. These are really only two choices: planning to make money, or losing money? Now, there are three business skills that every commercial enterprise needs to have: financial, production, and marketing. I think most of us go into farming because we want to do things and make things. We're focused on production. And of course, if you grow crops, you have to sell them. So marketing is kind of an essential skill also. However, most of us tend to put off or ignore the essential financial skills needed to be successful in business. I'm not saying you need to be an accountant, but you must be able to understand key financial tools, the language of business, in order to make good decisions for the future of your farm business. So of the three basic business skills, go ahead and admit it, you are the weakest in financial skills. If you know your weak spot, you can protect yourself by hiring or partnering to bring the necessary financial skill set into your farm business. You probably have a picture in your mind of the things you need to build your farm business, like land, supplies, and equipment. I want you to think of farm business records as another essential component of putting together and operating your business. I know record keeping is the easy task to leave until last, especially in the rush of your production and sales seasons. But for your long-term success, you have to have good record keeping in order to make good financial decisions. In my experience, people tend to get hung up on the difference. Wait a minute. There we go. In my experience, people tend to get hung up on the difference between making a plan and predicting the future. Nobody expects you to predict the weather and the exact amount of crop you're going to grow. But if you don't have clear expectations, you'll have no way to plan what might happen if there is a disaster. A lot of farmers look at record keeping as a way to comply with the legal requirement to file taxes. So at income tax time, that sort of farmer is in a mad rush to collect paperwork to prove their income and expenses. And only when they file taxes do they find out if they made or lost money in the preceding year. I want you to think of record keeping as the basis to set goals for success, to measure your progress towards your goals, and to get better at what you do by relying on your records to make good management decisions. For example, if you have good enough financial records, you'll know if you're making money or not on a particular crop, so you can decide to get better at producing that crop or stop growing it. One of the hardest things to do in managing a farm business is to know when to stop doing something. So let's take another look at these three essential skills: production, financial, and marketing, that are needed to run a farm business, and see what they mean in terms of managing the day-to-day operations. Managing a farm business boils down to asking yourself some basic questions. In order to answer those questions, you need to have records. Take a look at the question under production management that asks, what is the unit cost? Unit cost is what it takes to make one thing or unit of what you sell. And that could be 1 flat of plants, 1 pound of peppers, 1 bunch of flowers, 1 pound of beef, whatever it is. Knowing what it costs to produce 1 unit of what you sell allows you to set a price at which you know you will make money. Knowing unit cost also allows you to compare your costs to other similar producers through the process of benchmarking. The essential skill of marketing answers the question, who will buy it? Just as the essential skill of financial management is necessary to answer the question, can I pay my bills, or can I make money doing this? The 5-line income statement is probably the most basic description of how a business plans to make money. Take a look at the words on the left. That's a basic formula, right? In order from top to bottom. Gross sales minus the cost of goods sold equals gross margin minus overhead equals net margin. You can see a few other terms you might hear, like gross sales always, can be called total sales or income. But this 5-line income statement is what you need to know to describe how your farm business is going to sell something, sales, subtracting from that how much you will have to spend on supplies and inputs to grow or make the things you sell, which is cost of goods sold on this illustration. And that equals gross margin. I'll come back to that in a minute. And then subtracting gross margin from gross margin, the overhead costs equals the net margin or net profit. Income statements can get a whole lot more complicated than this, of course, but this 5-line income statement is whittled down to the basic equation that describes how you plan to make money. If you don't know this information for the farm business you're going into, you're really just going to be pursuing a hobby. Business people make money because business people make plans. Okay. The numbers shown on this five-line income statement, is that in the way up there? Hang on a sec. There. The numbers shown on this five-line income statement come from a small part-time farm business that grows vegetables and sells at farmers markets, a CSA, and maybe even some farm stand sales. Everything is sold direct to retail, meaning to consumers. This farm, in our example, is producing crops for direct retail niche markets, which is why the net margin of 10% is so large. By comparison, the long-term average net profit for a commodity crop like corn or soybeans is about 3% net margin. So this kind of business, selling direct to retail, is a good kind of farm business to use as an illustration of farm business planning because the monthly cash flows are irregular. In the vegetable business, you have to spend money up front at the beginning of the crop to plant it and then work hard to sell that crop in the months in the future. The cost of goods sold, or variable costs, refers to those things purchased to grow the crop that are used up in a year, things like seeds or fertilizer or fuel. For every additional pound of vegetables that's grown, it takes some small amount more of a variable cost, for example, another seed or a little more fertilizer, a little more labor to pick that vegetable. Variable costs are usually things that are used up in the year that they're purchased. Overhead costs, or fixed costs, are those expenses that whether you grow 1 pound of tomatoes or you grow 10 tons of tomatoes, you'll have that same cost. For example, whether you grow 1 pound or 10 tons of tomatoes, you have to pay the same rent for the land. Same for things like insurance, taxes, repairs, interest, and depreciation. That's what this mnemonic of DIRTI, D-I-R-T-I, is all about. You can think of overhead expenses as being all the things you have to have in place, like the land to grow on, before you can even think about buying the seeds and supplies to plant the crop. Those seeds and supplies are variable costs. The overhead costs are the things that you have to have in place before you can even think about planting a crop. Okay, so let's go back to that five-line income statement for a minute to understand why knowing the difference between variable costs and fixed costs is important. Again, variable costs, same thing as cost of goods sold. So the basic formula is gross sales minus cost of goods sold equals gross margin minus overhead equals net margin. So why is gross margin so important? Gross margin is a way of measuring how efficient you are at producing a crop. A different way to understand it is to look at the five-line income statement by percent of sales over on the right-hand side of this graph. Using percent, what this says is that if I give you 60 cents worth of supplies, meaning the inputs we're calling cost of goods sold or variable costs, you can turn that 60 cents into $1 worth of sales. That's how efficient of a producer you are. Gross margin is cost of goods sold subtracted from total sales. In other words, if you sell $1 worth of product and it costs you 60 cents in supplies to make it, to produce it, you have 40 cents left over to pay for the stuff that you need to have in place, like the land, like that dirty 5 that we just talked about, all the overhead costs, plus having some money for net profit. Okay. Oops, let me go back. So you can imagine that some farmers would have a much higher overhead cost if they paid more rent for land or actually bought a whole farm and had to pay a mortgage. Maybe they think they need to build a brand new barn or get a new tractor. That could make for a much higher overhead cost, but not really make the farmer all that much more efficient at taking 60 cents of variable costs and turning it into $1 worth of sales. A low overhead business is one that doesn't spend a whole lot on land or buildings or equipment, but concentrates on making money by judicious spending on the big things and energetic management of the variable costs. Either way, if you don't keep records, you won't know if you're meeting your expectations or if you're making money or not. Remember, this five-line income statement we've been talking about is for a whole year's worth of business, but farming requires constant adaptation to changing circumstances like weather or markets. So let's take a look how this five-line income statement can help us get through the year month by month and help us answer that financial management question, can I pay my bills? So Here we go. The idea of cash flow budgeting is really pretty simple. This slide shows how it works. We're taking our 5-line income statement, income minus cost of goods sold equals gross margin minus overhead equals net profit. And then to that, we add information from our checkbook, those 3 yellow lines on the bottom. The orange lines show the balance in the checkbook at the beginning of the month, which is the starting cash, and the balance at the end of the month or ending cash. The yellow line shows the difference between starting and ending cash, or how much cash has flowed through the 5-line income statement and checkbook. Looking at the red arrow at the bottom of the page, ending cash from one month becomes the beginning cash for the next month. Pretty simple. The idea of tracking your monthly cash flow resulting from your business operations 5-line income statement is that you'll know how much income and expense will happen each month and how much money that leaves in your checkbook to pay bills. Remember, we're trying to answer the question, can I pay my bills? So taking this concept of monthly cash flow and plotting it out over a year looks like this. Here we have taken the annual results of the 5-line income statement and divided it up month by month. If you look over at the last 2 columns on the right, you'll see the familiar annual 5-line income statement, the same numbers we've been looking at in previous slides. We still have our familiar 5 lines shown in green and our checkbook balance and cash flow in the yellow lines. Okay, so that was monthly for a whole year. This is what happens when you take that monthly. You can see across the top January, February, March, and take your expenses with details for the entire year. And hey, I get it. There are lots of numbers here, but don't worry. You can look for that familiar 5-line statement in the green lines, right? The cash flow spreadsheet, this one, is the same basic formula of gross sales minus cost of goods sold equals gross margin minus overhead equals net margin. That's all what's on those green lines. We've just added a lot more detail to show what is sold to produce the income, what labor and supplies are purchased to make up variable costs, and what part of overhead expenses are paid each month. And finally, down towards the bottom right-hand corner of the spreadsheet, we show the net margin in dollars, $13,959, as a percentage, 10.4% for the entire year. That's what we're expecting this small-scale direct-to-retail business to do in a year. All right. So during this webinar, I'm not trying to make you an expert in creating and using monthly cash flow and budget spreadsheets. The goal is to show you the cash flow budget tool and convince you it's in your best interest to use it. There's a whole bunch of online courses in how to do a simple 5-line income statement and expand it out to that spreadsheet. You can do that some other time on your own. But the idea is it's important to know that. And if you don't want to do it, if you don't want to keep those records, making sure that somebody else is doing it, paying a bookkeeper, for instance, to do that is going to assure that it gets done, because you have to have good records to make good decisions. Okay, so as the manager of your farm business, you're also taking on the role of being the chief financial officer. And really what that means is you're going to make decisions about how money is spent and how money is made. You can make money-related decisions without any financial statements, but that's kind of like driving down the road at night with your headlights turned off. You could be lucky, or things could go very, very wrong because you didn't see what was looming up right in front of you until it was too late. Running your business is all up to you, but I think that you need to use those 3 financial statements in order to be able to see where you are going and know where you have been so that you can make effective decisions. Lenders want to see 3 main financial statements. I've already talked about the monthly cash flow budget at length because I think that's the most important financial statement from the perspective of the farmer. In other words, that's the information where I get how am I going to sell my stuff? What's it going to cost me to produce it? And can I pay my bills? That's all in that cash flow statement, which is important to the farmer. And that cash flow statement does 2 things really well. As a budget, it explains for the plan that you have for your business over the course of a year. And as a way to track and monitor what's going on, it helps you month by month by allowing you to measure your performance, what you actually did against the budget that you set, so that you can change what you're doing. From a lender perspective, what's most important really is the balance sheet as far as a financial tool. And that tells you what you own and what you owe. So let's take a closer look at what a balance sheet looks like. Assets are things that you own or have control of. When you're young, you generally own fewer things, but it's important to know what you own, all the things you have, your stuff, so that you can take care of the things that you're responsible for. Liabilities are the things that you owe to other people, loans, accounts payable, leases, and so on. If you take what you own or control, subtract what you owe to other people, you're left with your net worth. Another way of saying net worth is wealth, or the sum total of what you have if you were to pay off all your bills and loans. A balance sheet is a snapshot in time. It's a report of your net worth as of a certain date. A lender wants to know your net worth in order to find out what you're bringing to the borrower-lender relationship. What are you going to put on the table? You want to quantify your net worth to be able to show yourself and your lender that you're making financial progress over time. Getting a loan to buy a farm is a long-term partnership between the lender and the borrower, where the lender wants to know how much wealth the borrower is going to put into the deal and what they're willing to commit of what they have. The third financial tool that you should be familiar with in this language of business is the income statement. If the balance sheet is a snapshot in time that tells what you're worth, the purpose of an income statement is to show whether the farm business made or lost money during a particular period of time. An income statement might also be called a profit and loss statement or an earnings statement, but it starts with income, what money the farm business received. Expenses are then subtracted from income. All the supplies and payroll and all the bills paid to operate the business are included in these expenses. And so the simple formula for an income statement is income minus expenses equals net income. You may be thinking this sounds a whole lot like the cash flow statement, and it indeed and does. And from a lender perspective, an income statement is a more formal way of showing how the business earns money over time, with adjustments so that 1 year of business performance can be compared to another. So I guess it's time to put a bigger perspective on this. So a word on how these three financial statements are used to explain your farm business idea if you're going to seek a loan or assistance in case of a disaster. And that's the idea of a business plan, a written recipe for how you're going to build and operate your business. A business plan is a communication tool that allows you to tell other people what you intend to do and to ask for their help. That's what a business plan is for. It's a way to ask for other people's help. A complete business plan for a new farm business is going to include that balance sheet showing your net worth on a recent date, an income statement that shows how you expect the business to perform in the first year or two, and a monthly cash flow budget for at least 1 year into the future. Remember, don't get hung up on the difference between predicting the future and making a plan. Planning, particularly planning that uses a monthly cash flow budget, is the easiest way, is the way to test your business ideas on paper before making mistakes in the real world. Your ability to show a lender that you can reasonably plan for the future shows that you have the skill set to manage your business and succeed. Operating a farm business requires you to adapt to new conditions, threats, disasters, and even opportunities on an ongoing basis. Change never stops. Managing change is the job you sign up for when you become a farmer. So as a beginning farmer, you can probably describe your dream farm pretty well. And now you know the key financial statements that your business plan should include to describe that dream farm. But that still leaves you with the question of where to get the money to pull it off. And there are probably several different lenders in your area from which you can seek a loan. Most are going to offer very similar loan products and pricing. And there are others that are probably much more experienced in farm business lending than others. And importantly, some offer lower costs or reduced lending standards for beginning farmers. Your decision on where to seek a loan should be a combination of these factors. However, your ability to obtain a loan is going to depend most on your creditworthiness, which is your history of repayment of past obligations. For beginning farmers, a common problem is not having enough equity, which is your net worth that you pledge as your investment in the project in order to qualify to get a loan. It's true, you need to have money in order to borrow money. What I've talked about so far is the need for you to understand the three financial tools that explain your own farm business. But what about the other side of the deal? You also need to understand how your lender assesses you. Perhaps the most important thing I can tell you is this: borrowing money should always be seen as a negotiation between partners who each need to get something out of the deal. Knowing what the lender is looking for will help you meet their expectations. This slide shows the 5 C's of credit and some of the questions that are on the lender's mind as they evaluate starting a long-term relationship with you that's called a loan. The best way you can make a good first impression on a lender is to bring complete and coherent financial statements with you to the interview. It's worth calling that lender ahead of time and finding out exactly what financial information the lender wants to see so that you're meeting their expectations. Lenders are in the business of renting money to people. The rent is called paying interest on the loan. A lender's goal is to rent money to somebody who has a plan to pay it back. Your job as a borrower is to describe your plan to pay it back. You should be prepared to tell your story in a way that the lender understands, using both words and numbers, which sometimes means a formal business plan. The bigger or more complex the loan request, the more supporting information you're going to need to show repayment capacity. For a lot of lenders, it's essentially illegal for Farm Credit anyway to make a loan where we can't document how the borrower is going to pay the money back. You need to know how you're going to pay the money back, and the lender needs to know how you're going to pay the money back. Not just to protect the lender, but to protect you, to make sure you know what you're getting into, which means you need to understand the plan that you have to borrow that money and put it to use and earn more money so you can pay the loan back. If you're going to apply for a loan, it's also a good idea to know what the lender doesn't want to see. First on that list of things that really turn off a lender is poor records. And that includes not having basic financial information like a balance sheet, an income statement, and a cash flow budget. You've got to speak that language of business. And probably a lender's going to want to see tax returns for the past few years. If you haven't farmed before, be prepared to discuss the management experience that you have gained working for somebody else. Also on this list, you'll see that not having a plan B is a turnoff. You should be able to describe what happens if things don't go according to plan, how you'll respond to problems that you've thought of in advance. For example, having irrigation if the weather doesn't cooperate by providing rain. This is where disaster planning comes in. You don't have to imagine every disaster, but the more things that you plan for, the better you become at planning, and that's what a lender wants to see. A build it and they will come sort of business plan is one that ignores the marketing or advertising necessary to sell the product. You may not like marketing, but you have to be able to describe how and where and to whom you're going to sell your farm products. And last on the list, you need to be able to communicate that you have the stick-to-itiveness, that you understand the nature of the work involved and are committed to the success of your farm business. So the essential basic business skill that you need to show is the ability to think through and plan what you want to accomplish in your farm business. The best thing you can do in a loan interview is show that you are business-minded, that you can describe how you'll productively invest the money from your loan and how you'll pay the loan back. Think ahead. If you're turned down, what will your reaction be? Will you be, disappointed or angry or resigned? Or will you ask the loan officer, what do I have to do to change your mind? If you're prepared to think like that way you're going to find out exactly what you have to do in order to obtain that loan. So here's a list of things to do before you start farming. Most of what I've talked about today falls under the fifth item, plan. Please don't wait till the last minute to try to pull together a balance sheet, an income statement, or a cash flow budget. It's better to spend 15 minutes a day over the course of a couple of weeks pulling together your information than trying to do it all at once. And a last thought before Diego goes on to make some more pointed remarks about disaster planning. Farm Credit is an authority on the ag economy, on farm business, and is an advocate for beginning farmers and ranchers. We believe in the future of agriculture, and we believe in you as farmer veterans. So with that, Diego, I'll stop sharing and let you let you be the guy here.
Yeah. So as you were speaking, I kind of wrote a few notes. So you mentioned a complete business plan, right, for a farmer and rancher, and you said, it should have a balance sheet, income statement, monthly cash flow budget. What about like a recovery plan? How would that look for someone that's never made one before? How would that look?
So have the more that you can show a lender that you have thought of the plan B stuff,
Yeah.
what happens if things go wrong instead of how wonderful it's going to be when things go right. The more you can show that to a lender, the more prepared you will be, and the more confidence that lender will have in your ability to plan and your ability to have thought through what it is that you need. In my greenhouse business, I needed electricity. I had my backup plan. My plan B was I had a generator, and then I had a plan C, which was a backup to the backup generator. My lender kind of liked that kind of stuff, that you're really thinking through that you're going to have the essential features of what you need in order to continue doing business.
hmm So I'm assuming like start an inventory, document your losses, your damages, and just any available resources, right? Like any local programs that are available to you, anything like that. Is there anything else that would be good? I know you said like plan Bs and stuff and having your backup plans, but what about like
Yeah.
any urgent needs maybe or anything like that?
Yeah. So the back to that, how I described it, Diego, was that if you're planning for, you know, bad things that are going to happen, the more you do that kind of planning and thinking through, what do I need? Well, I need to back up to my backup generator kind of thinking.
Yeah.
Um, the the more you're going to be able to come up with a plan for the unique circumstances of some disaster, right? So thinking of some of the disasters recently, a road washes out. Too much rain, a road washes out. You can't go to that farmer's market as easily anyway as you could before. So where are you going to sell your stuff if you can't go to the farmer's market you usually go to? How can, in the case of disaster, maybe you turn that business into selling to an entirely different sort of customer, because the need is different. Think back to COVID, right? A lot of the direct to retail sales that happened at farmers markets stopped because people couldn't get together at a farmers market. So many of those producers who had direct to retail marketing channels had to switch to go to um, institutional channels like grocery stores or other food wholesalers.
Okay. And look at my notes here. So when should I explore the possibility of refinancing a loan? Any tips for that, especially, with disasters and everything that's going on?
Yeah. So, I mean, this isn't going to sound good, I guess, Diego, but to have a relationship with a lender before you need to borrow money, for a disaster is really the essence of disaster planning for having access to credit. If there's a saying among uh, borrowers, I guess, something that some old farmer down the road told me is never borrow your last dollar, right? If you have no capacity to borrow more for an emergency or even an opportunity, um, then you're going to find you're missing out on a whole lot of stuff. And the worst time to go to a lender is when you have had a disaster and you have no previous relationship with that lender.
Yeah.
So you don't have to be a borrower. You don't have to borrow money to be a real farmer, but you better have access to credit, have a line of credit perhaps with a lender, um, just in case you have a disaster and all of a sudden you find yourself needing a whole bunch of cash to, I don't know, buy a different truck, put in a generator, whatever it is that disaster is going to make you wish you had.
Mhm. Do you have any examples of any I know you brought up a bit, but any like just bad practices or any cases where you've seen like someone was really unprepared or didn't know what they got themselves into. That way our
Well,
viewers can avoid
it's
those.
it's the thinking through, when you've had a disaster, in the greenhouse business that I was in, my disaster was the alarm failed in the greenhouse, and I froze a whole greenhouse full of cut flowers the week before Valentine's Day. It was pretty serious.
Yeah.
Um, it was a bad day on the farm, I can tell you that. And the the thing that I did after I got through kicking myself in the head and irrigating and doing the things to help those plants recover as quickly as possible was to call my loan officer and say, I have had a disaster. I don't know what it means for me right now, but I know it's not good. Um, because this is the biggest week of the year for sales for me, and 1/3 of my production just got frozen. Um, I'll let you know how it goes. But the idea is that I want to get across is when you have a disaster, if you are a borrower already with a lending institution, call them and say, I have had a disaster. Things are not going well. I'm not sure what it means right now, but I just want to let you know ahead of time. And that helps. That kind of phone call and being, I don't know, forewarning the loan officer, the lender a little bit, is what helps a whole lot when 2 days later you call up and say, I need to expand my line of credit so I can buy the generator or the oil or whatever it is that I need to fix that particular disaster. Um, so um, I guess the answer to the question is, when you've had a disaster, figure out who you need to communicate with quickly. And
Yeah.
sometimes that's the lender you already have a relationship with. Sometimes that would be, um, for many people, it's going to FSA for an emergency loan. If that your whole county has been declared a disaster area, and that's how we usually think of disasters, right? As too much rain, wind, hurricane, whatever it is, the whole county. That's true. That's a big disaster. But what is more common on a farm business is your own farm's disaster, right? Not having a generator, the irrigation pump crapping out, or whatever it is. Planning for what happens on your own farm is within your capacity to plan. It's much harder to plan for things that happen outside of your farm, like in COVID, having to switch from direct to retail sales at farmers markets to find um, a a food system wholesaler that could buy your product.
Okay. That's about all that I have. Real quick, I'd like to share my screen to show the resource that we have at FEC. So, can you see the webpage?
Yes, I can.
Okay. So, again, so for the past year, we've been doing work with Flower Hill Institute as well as other collaborators to provide technical assistance and just information about the programs available to you, specifically FSA programs. So on our website, if you go to resources and go under there where it says FSA Toolkit, you'll see a whole web page of just programs available for you. Um, there's a drought monitor map. There's different programs for different kinds of emergency assistance. There's loan resources, disaster planning, all kinds of resources that are available to you for free to look at whenever you need to. Again, this is our last webinar of this series, but this information still will be available to you whenever you need it. And if you have any questions, please reach out to us anytime at support@farmbeco.org or to Chloe or even to Gary. I know Farm Creator has a bunch of resources as well that he can share with us, and I'll put it in the video afterwards. But that's all that I have. Gary, any last words? I'll let Chloe say a few words as well.
Oh, thanks for the opportunity to be a part of this webinar series, Diego. I'm glad that Farmer Veteran Coalition has put the effort together. That resources page is fantastic. That's a great place to go, but that's after you've done the planning for your own business success, right?
Yep,
Um,
absolutely.
so start with a plan.
Yes, absolutely. Chloe, any last words?
Not a whole lot. Just thank you so much, Gary. That was really, really good and educational. Just, I think people will get a lot out of that. So thank you so much.
Thank you, Chloe.
All right, and that'll be it. So this webinar will be on our YouTube channel shortly. And again, if you have any questions, please reach out to us, support@farmveco.org. But again, thank you, Gary, and thank you, Chloe.
Thanks for having me.